Okay, now to help us break down the fundamentals behind the technicals, I got Fritz Folts joining me, Chief Investment Strategist at Hedge Asset Management. Fritz, good to have you with us this Tuesday. Let's begin with crude oil above 84, posing a risk to the Fed's inflation progress, I feel like.
Yeah, you're absolutely right there. And I don't think I'd be a very good oil trader, but I certainly learned a lot from you going over those charts. I mean, that's sort of the fly in the ointment at this case, because I do think, we are seeing the economy slow. I think we're going to see the job market also gradually slow, and those are helpful to the Fed. But higher oil prices, though, that is very inflationary, and so that could be potentially a problem for the Fed. I mean, no doubt about it. We have to keep our eye on.
I feel like a headwind for stocks at this point, especially if we take out 87 and there is some momentum to the upside. And I always talk about these wider ranges. Build your way, build momentum through the middle of it, and ultimately you retest an upper extreme, which would target us around that 95 level. So obviously even more concerning. But let's talk a little bit more about the Fed. With Powell today, I think there's a lot of focus on as the dust settles from the PCE data last week, and as we gear up for the jobs reports. You mentioned the focus being on labor conditions, right, and the slowing economic conditions we're seeing. But you think that the Fed's either been lucky or good, you said, Fritz?
I mean, I think so. Remember we were all at the beginning of the year talking about how there were going to be 6 rate cuts, et cetera, et cetera. Here we are mid-year. We are starting to see the economy show signs of weakening. We're starting to see the job market show signs that it's softening somewhat. We'll see the JOLTS report, I think, a little later today. So, I have to say, first of all, it's a very difficult thing to do because of the lagged effect of tightening monetary policy. When do you begin to cut interest rates? But so far, I think, they've done the right thing. They've waited. They've been patient. But I think now at this point, I think these numbers continue to soften and we could get 1 or 2 cuts this year.
You said, Fritz, that we were all expecting more rate cuts, right, than earlier in end of last year, earlier in this year than it's turning out to be. I would argue all of us except for the Fed in many ways, right? They had a more level-headed approach towards everything, tried to ease some of our expectations or cool those expectations. And then we've been debating and talking quite a bit on the show about how in many ways the dollar and yields have had that kind of level-headed approach towards things as well, right? They haven't really got caught up in the spin, the cycle of those expectations, as they've been very much range-bound and contained.
It's interesting because sometimes the way I look at that is, the market's just trying to beat up the Fed for a period of time, really pushing, trying to get to start
force their hand.
Yeah, exactly. And great. That's great. If you're an investor, that would have helped everybody. Not that the stock market needed that much help this year. Yeah, I mean, but they held their ground, and I think he did the right thing. And he doesn't want to be, the next Arthur Burns, the next person who attacked inflation, fought it, and then yielded too early and saw a resurgence of inflation. I think that's definitely on his mind.
We were just talking about crude oil, and we looked at it through the lens of those auction market theories, those concepts, those ideas, those principles that state that we're either in the vertical phase or the horizontal phase, and the transition from the two helps us determine trend as we see that staircase-type pattern play out. Fritz, I wanted to get your thoughts on gold, because take a look. Here's another one of those patterns, right? This is why I'm attracted to this methodology, this kind of lens of looking through price through, because it repeats itself over and over. We're talking commodities, currencies, options, ETFs, stocks. I mean, bull, bear, short-term, long-term. I mean, this is really a robust kind of way of looking and viewing price activity. But talk to us about what's playing out with gold here. I mean, still in a range, in balance, and it looks to me like the bulls are in control here.
I mean, I think so. And again, we're multi-asset investors, and so chances are always going to hold some gold in our core portfolios. But there are a lot of reasons why it's a good idea at this point. First of all, it's a great hedge against geopolitical uncertainty. It's one of the few asset classes that benefits, from some global tension, from the conflict in the Middle East, from what's going on in Ukraine. So gold is a good thing to have in your portfolio for that. And also, as governments have taken on more debt, and they have record levels now, they may be forced into policies that are more like financial repression to keep the cost of servicing that debt down. And the net effect of those policies is to weaken the currency, and gold benefits there. We've also seen central banks, particularly those central banks in countries that are not aligned with the U.S., they've been swapping out of treasuries and into gold. China's a great example. They don't want to have U.S. Treasury holdings that could be sanctioned, right, by the U.S. government if the conflicts and tensions with China heats up. And lastly, if real interest rates were to come down from here, and there are two ways that could happen. If inflation expectations, which are fairly low now by historic standards, were to move higher, or if interest rates were to fall faster than the rate of inflation, real rates would decline. That would be also very good for gold. So we feel like it has done well. I think it's up about 13% this year, but it's a good hold for us for the longer term here for the reasons that I just stated.
Fritz, at 3Edge, you hold multiple assets, as you mentioned here, but you also have a longer-term approach towards trading, right? And I think, take a look at this chart. I mean, we just looked at the move up we've seen over the last year, trended it out, right, established these areas of balance, but now I've gone way back to 2005. I mean, Fritz, take a look at this. I mean, here another instance where that longer term kind of take a step back from the tick-for-tick type approach towards trading helps you see a real clear picture.
Yeah, absolutely. And again, we're not traders. We are long-term investors, but we will lean into gold more or lean away from it. We have fairly wide ranges here. And right now we're actually at the higher end, and that served us well so far this year. And that was even in the face of rising real interest rates. So we like the asset class, and not a lot of people have it in their portfolio. So we think it's added value to hold some here.
All right, Fritz Folts joining us here this morning, taking a look here at a couple major markets here that we should be watching as we await the Fed today, Powell, and some of the data this week. Lots to keep an eye on here when you're talking about markets here this morning, whether it be commodities all the way through financial markets. Fritz Folts, Chief Investment Strategist at 3Edge Asset Management.